This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Oil's not as expensive as it should be, and the markets are doing better than the data would suggest they should. On this week's show, we look at why that is for now and who's going to be right in the long term. Welcome to the Wise Investor Show podcast. On the heels of the greatest comeback in NBA history, I wish I could just talk about the Knicks all day, as I'd have a lot more to say, but you probably are not tuning in to hear that, at least not for me. If you want to hear some good vibes and humor, go on YouTube and look up Spike Lee's post-game interview on the NBA Network. That's really good stuff. But I'll move on and first just focus on what the narrative in the markets today, after we had not a correction, but a little bit of a correction in the tech markets, with the NASDAQ seeing an almost 5% slide last Friday, and further selling this week before a bit of a recovery here on Thursday so far, despite mostly negative headlines for the markets. The war with Iran is taking maybe a turn for the worse, as there was optimism that there was going to be some sort of resolution soon. But we seem to be about to go back to full-on fighting, and the Strait of Hormuz is still shut down. But the headlines in many publications today, including the Wall Street Journal and the Financial Times, are pointing to efforts in China to vastly reduce their own oil consumption, and that's keeping prices from getting out of hand for now. On that topic, over in Grant's Interest Rate Observer, they wrote this week, quote, Xi Jinping to the rescue, pointing out that China imported less than 8 million barrels of oil per day in May, which is down from about 12 million barrels a day, which they imported on average last year. And this is their lowest recorded rate since 2017. And, maybe it's a reflection of their economy, but that's really not in the data. Maybe there's some black or gray market oil coming in that's not showing up in that data. But they say that China has been backing off their consumption, and that's playing a crucial role in keeping a balance in the global energy markets, and that the extent of this effort has taken the markets by surprise for now. Additionally, though, U.S. oil exports are actually up 50% year over year for the month of May, and that supply was juiced up a bit by a release from the SPR. But this, while a positive for now, keeping the prices not low, but maybe lower than they would otherwise be, it raises the question that if the strait does remain closed, what happens when China can no longer show this reserve, when they can no longer use their reserves, when they can't afford to keep their fertilizer production reduced below the levels they require to grow the food they need? Depends on the timing. If this keeps up, the prices we've endured recently could just be a pleasant memory if energy costs really steam dramatically higher from here. That's what could be around the bend, but remains to be seen. You could say the oil situation is fluid right now. Prices are actually down last I checked. For what it's worth, though, OPEC actually agreed to increase their output sometime over the last week. But with the Strait of Hormuz blocked, that really doesn't have a huge impact, and much of the OPEC nation's storage capacity is maxed out. But for those of them that can get some of their oil piped out, primarily the Saudis, well, this is just going to allow them to continue winning 2026. The Saudis are going to do very well this year. And maybe if there's another 180-degree turn in the war, which seemed to happen this afternoon, it'll allow for a swifter recovery to some extent. But more on what happened this week. We did get a lot of economic data. We got the key inflation data, the consumer and the producer price index numbers for June. And headline inflation came in at a whopping 4.2%. The headline consumer number, which does include the price of food and fuel, both of which are up a lot this year. In fact, beef prices are being squeezed not only because of higher fuel costs, so that part of food is kind of double counting the higher energy prices here, but feed is more expensive, again, because of inflated oil prices. So that's why oil itself is expensive, but trickles down to other costs. And also There's some drought-like conditions across the country. And now we've also got the discovery of some kind of terrible bug, worm thing reappearing in the American beef stock after being apparently eradicated many decades ago. I'm not sure if that's a major problem, but it has seen some speculation on beef prices. But we're told we're to ignore the headline inflation numbers, I guess, unless you're a consumer or someone that may be worried about the consumer's ability to spend in the markets. And the core inflation numbers for the CPI came in at a more muted 2.9% rate year over year. That was right at the consensus expectation, a tick higher than the April reading. And the month-over-month reading was just 0.2%, lower than the forecasted expectations and the 0.4%, which we saw for the month of April. So fear not, consumers. As long as you don't need gas or food or to buy anything that needs those products, May was a good month for you. In fact, average hourly earnings were up 3.4% year over year. And that's a net gain for households versus the core inflation number, yet still not showing a real gain in wages when you adjust for inflation versus the headline cost. For what it's worth, the average 30-year mortgage rate remained unchanged for the period at 6.6%. But we did see a big upside surprise in existing home sales for the month, and mortgage applications also surged, as reported this week, up over 10% week over week. So signs of life in the data this week for the housing market. For producers, which eventually go on to charge whatever inflation they're seeing to the consumers, and really, that's not actually a foregone conclusion. Over the past year, producers have absorbed a lot of the inflation in the system in order to maintain their respective market share. But much like the Chinese using less fuel for now, eventually the producers are not going to eat all the costs of inflation. And that's another whammy that could be hitting the economy potentially over the next 6 or 12 months. But for the month of May, producer prices rose on the headline number by 6.5% year over year. Pretty big number there, higher than expected, and a surge over the 5.7% seen in April, while the core year-over-year inflation number was 4.9% for producers, and for the month, up 0.4% versus the estimates of 0.3%. So you see, inflation for the producers substantially higher than it is for the consumers so far, but one leads to the other. Oddly, not only did the markets rally on Thursday when that data was released, which would seem to further pave the way for rate hikes in the future, but this was largely a rebound after a pretty good rout in the markets, especially in a lot of the tech names earlier in the week. But we also saw the bond market rallying, with the 10-year Treasury yield dipping, again, just below that 5% demarcation line that I've pointed out has been such a burden on equity rallies when that yield trends higher than 4.5%. It's worth noting, though, that while the volatility index, or while volatility itself has emotionally seemingly elevated, the VIX index that measures it or tries to remains today below 20, which is an area below typically concern. And the major indexes are still up, typically in the high single digits so far for the year. The QQQ, the really tech-heavy QQQ, saw a 5% drop just in one day last Friday. But as of this recording, the S&P, the Dow, the NASDAQ, they're all down now roughly, give or take, about 5% from their all-time highs. And it seems with all these negative headlines, like I've harped on here today, this is surprising many investors who feel like a lot of investors have one eye on the door, or to invoke my lame analogy from the podcast a couple of weeks ago, they're still at the party for now, but they've picked up and are carrying around their coats right now. Still, within those numbers, 40% of the stocks within the S&P 500 are actually negative year to date. But even the equal weighted version of the index itself, though, is still up mid to high single digits as of today. And you must know there's a whopper of an IPO hitting the markets tomorrow on Friday. And while it won't have a direct impact on the economy, it's going to be interesting to see how well it cozies into the other mega tech names in the market and if it maybe steals any momentum from them. You'll have some more information on that by the time you hear this because you'll have this after Friday. But over the next many months, we'll see, is equity or is capital going to have to come from some other areas in order to funnel into that stock if it does indeed see continuing demand after it goes public, and what happens once a lot of the lockups happen over the next 30, 60, and 90 days. At least as of this recording, though, as far as Iran's concerned, the massive strikes that were were expected for this evening, have now been canceled. So that's good news, and that's why we're seeing a bit of a rally in the markets. Surely, again, in the next few days, that news will have changed. But strikes are off for the night. We're going to focus on soccer this evening. It's really moment to moment for now. But for now, I'm going to take a quick break, and when I return, I'll do a bit of a review on the exciting world of interest rate curves and their effect on two major industries. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Midterm election years are almost always the most volatile, and so far 2026 is proving no exception. Will you let the inevitable churn in your political leanings disrupt your plan and portfolio? Tune in every week as we discuss the latest financial trends and what investors need to know. To avoid the endless barrage of distractions and become a better informed, wise investor, listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Can you believe I saw an article this week that was describing how the markets have typically done in years that had the World Cup soccer tournament? I didn't bother reading it, but I saw it, just like I'm not really into reading how the markets do if the AFC versus the NFC wins the Super Bowl. Maybe they should include how the markets did the last time the Knicks won the championship, which was 1973, and was really not a very good time for the stock market. It was a particularly bad two back-to-back bad years in the market. For what it's worth, I do think Chechnya, which we formerly called the Czech Republic, has a very good chance to upset South Korea tonight. But by the time, again, you hear this, that'll have already happened, so not much help. But the point of the World Cup comment is really that there's not a lot of new material to discuss right now in the markets, if you can't tell. The economic data that we've shared is not encouraging, but a market and an underlying economy that's being driven higher by the expansion of AI has and can continue to seemingly blow that off, while we should be wary of what lies beneath the surface, which is why we pay lip service to all this data. But instead of historic measures of what the market does when the World Cup is played or whatever, I updated some data, and I want to take a quick look at what spreads look like today in the bond market and what that means for some businesses. I'm not getting into the spread now of how junk bonds yield versus investment-grade bonds or other spreads in respective lending, which has an effect on economic growth. And I did mention a couple of weeks ago, I think, how much of the investors' liquidity today has not come out of the stock market, even though there's ample liquidity, but most of that seemingly has come out of the bond markets rather than just being sidelined from stocks. But I want to take a look at what different maturities of treasuries yield versus each other. The spread in yield, for example, between a 2-year note and a 10-year treasury bond right now is about 0.38%. If you were to lock in a purchase of a treasury for a decade rather than getting your principal back in 2 years, you're getting 0.38% more per year in yield for that extra commitment. And if you're buying bonds as an investor, other than maybe laddering them with different maturities, you maybe would buy the longer maturities because you think that over that period, rates would trend lower. So you would buy a longer bond and lock in the higher rate, rather than having it mature sooner and being able to reinvest it again at higher yields if you think rates are trending higher. Well, expectations recently have flipped from expectations that yields would go lower. The Fed would cut rates as inflation calms down and yields would fall, to now the Wall Street baseline is that rate hikes are more likely, albeit on the very short end, which is what the Fed really has their thumb on. They try to mess with the long end of the curve. They can buy treasuries, they could buy mortgages, and they have. But really, when they say rate hike, they're talking about ultra short term. A month ago, that same spread, 2-year to 10-year, was 0.48%. And a year ago today, it was at 0.47%. So that means that money has either been more willing to stay in the longer end, or that buying has been more attracted to the longer end, pushing those yields lower relative to the shorter end. Maybe not actually lower, but on a relative basis, which may be surprising if you think rates are headed higher, which they have. But again, the longer end isn't as much higher as the shorter end, but not so fast here. For the same time period, now a week ago and a year ago, the 3-month T-bill, which does reflect more of what's expected and what's received from the Fed versus the 10-year, the opposite is true, where the spread has increased over the previous month and over the spread a year ago. And that's where you're seeing the anticipated Fed action, as their primary impact is on the very short-term rates. Okay, so boring stuff there. But the point here is twofold. First, the curve is now flatter than it's been recently and it was a year ago, which historically is accepted as a reflection. It's a reflection of an existing or an anticipation of a slowing economy. Traditionally, an inverted yield curve, which is when higher rates are actually on the shorter end and longer bonds are yielding less even, not just flatter, but less. Well, historically, that's known as a harbinger of recession. And that was discussed a lot the last time it happened, which is from the period of 2022 until late 2024, the yield curve was inverted, but recession didn't occur at that time. So it's not a fail-safe predictor, but also the changes in these spreads have a major impact on the bottom line of banks and insurance companies. A major source of profits for banks is their so-called net interest margin. They borrow money short-term. They borrow money in the form of deposits, like what you or a large institution may be having sitting into an account there, the cash you have there. That's the deposit. And they take that money, lend it long-term. They take that deposit and they lend it out in the form of commercial loans or mortgages and such. And the difference between those two rates, what they have to pay you and what they get paid, is the net interest margin. So when the spread there expands, when the yield curve steepens, when the mortgage pays them much, much more than they have to pay you in interest, they're printing profit. And because of this, banks are also more excited to lend money when there's a big spread. And that can help the economy because lending is more readily available. They're more likely instead to reserve capital or find other applications for it than put it at the same level of risk if they're not making great levels of profit in it and they don't have to compete on loans, which is what we saw when it was inverted in that period I mentioned. And a lot of commercial lending dried up and people who wanted to borrow money had to go to less traditional sources of funds, which were that much more expensive. And that led to a reduction in economic activity. Insurance companies aren't that different. They take in the premiums that the insured parties that you might pay for the insurance policy. They take that money and they invest it to make a profit as long as they carry that money until they have to pay out a claim. And that's why underwriting is so important, because it's not the case of one insured party passing away or putting in a claim because their house burnt down, but how many of a large group of insured parties, insure 10,000 houses, how many of them get paid out on average? And if the underwriting is done well, the insurance company may make some profit on that underwriting, But many of these companies actually lose money on underwriting, yet still make money overall because they're making a profit on the carry investment. And some prominent names, which we've talked about on the show many times, big insurance companies, also take that cash when they have enough of it, and they can buy stocks or even buy out entire private businesses, which they will continue to own and profit from. But most of them invest the cash. The typical behavior of a big insurance company, take the cash and invest in bonds. And they typically orient towards the longer end of the curve. And when these spreads shrink, like they are now, and when the curve flattens, they too see their profits diminish. What's more, because they're often carrying billions in dollars of bond holdings, if the long end dips, they can suffer even further because they always have some of these bonds maturing that they've been buying over the years, and they would then be reinvesting them at lower yields. But we're really not seeing that yet because, as I mentioned, yields are actually still higher this year and certainly longer than they've been over the last decade. But it's the spread that's the problem today and showing up in today's stock market more in the prices of banks than it is in the price of insurance companies so far, especially the big commercial banks that are more reliant on net interest margins, more traditional forms of lending than the really big banks that are making money doing various other things. All right, I guess the bottom line today is that while the AI fun time still trucks along, albeit with some notable speed bumps here, the financial sector is both showing some concern for how well those companies may be doing, as well as potentially reflecting another sign or reason to be cautious as we look ahead. That's it for me this week. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.